Jeremy Green, Director of Advanced Planning for CBS Brokerage. Today I'll be discussing the optimization of step-up in basis at death relative to the minimization of state and federal estate taxes. There's three things we'll be discussing. That state location matters, the characterization of the assets transfers matters, and so does the actual framework for decision making. So a key concept is that when we transfer assets off balance sheet to save on estate taxes, we also lose the step up in basis. And the value of that transaction depends on the location we're at. So without getting into a ton of detail, I've got a chart here of three different kinds of states. States that have high income taxes and high estate taxes, states that have neither of each, and then finally states that have high income taxes but no estate tax. California being the example of the later, Florida being the one with no taxes, and Minnesota being high income tax and estate tax. You can see the delta between the three. You're saving anywhere from 30 to 40% on these two states between the capital gains step up lost and the value of the transfer to a trust, for example. And in a state like California, there's only about a 10% difference. So it's a lower value in transferring assets in a state like California. One of the questions that I get often is it worth setting up a trust for states for clients that don't have federally taxable states but do have a state taxable state, such as Minnesota? And my answer is it depends, but many times not. It depends basically on the actual underlying basis of the asset they might transfer into that trust at the first person's death. Yes, you will save on estate taxes at the first person's death setting up a credit shelter trust. However, you then lose the step-up basis on those assets. So if the assets transferred in that trust had low basis, you saved 10% on Minnesota estate tax, but you lost on 20% on the capital gains, on federal capital gains rates, assuming the highest tax rates. The assets that you transfer, or the characterization of those assets matters, and that's what I have a flow chart here, a breakout of the different types of assets and how they're taxed. Some assets are taxed at 28% capital gains rate, some's at 20, those are the max rates. Some assets are taxed at ordinary income tax rates, as you're aware, and some assets will get no step up in basis. Without needing to go through all this, I just wanted to highlight that fact when we look at a balance sheet. So I have an example of a typical balance sheet I see from advisors. Most advisors put together something like this. They'll have the asset broken down by asset type, qualified, capital gains assets, so forth. They'll have the fair market value of the asset. They'll have the liabilities attached to that asset, and usually they'll have ownership broken out by three columns: his, hers, and joint assets, or if we're assuming that it's a married couple. So for simplicity purposes, I just merge those into one column. But for clients that have federally taxable estates, this is not adequate for making decisions around what type of assets to transfer, particularly if they have a lot of assets and a lot of different types of assets. So I took that prior screen and I broke it out by what advisors usually do. I'm going to fill it in with the stuff that should be in there, and what I call an actionable balance sheet that clients can make decisions off of. So the things that are missing that you would need to know is, number one, for somebody who had a federally taxable estate or has a federally taxable estate, you usually won't use fair market value for the estate tax return for certain types of assets, like closely held business interests, which would get a discount on valuation at death or at transferring during lifetime or gifting, anywhere from 15 to 30%. So you can get discounts for lack of marketability and also for minority interests if it's a minority interest to have. If it's a majority, you wouldn't get a discount. That's why I have 15 to 30% discount. You should have the cash flow of the asset, because if you're going to gift an asset, you need to know if it produces additional benefits such as cash flow. You need to know what the cost basis is. Again, is it going to get a step up in basis on the balance sheet where it wouldn't off, for example? You need to know the growth rate. Is it going to appreciate highly off balance sheet, or is it not? If it's not highly appreciating, then maybe you keep it on. If it had a high basis and not appreciating, clearly that would be something to keep on balance sheet. If it was something with a high basis, high growth, it would be something to transfer off, because the trust would pay capital gains rates on only the future appreciation. So I basically take all this data and I sort it So I rank it by what I call a cost basis to fair market rate value ratio, particularly for clients that have multiple LLCs or business interests where you're trying to decide which one of those interests are best to use. If they've got debt attached, that's something else to be aware of. That would be a boot to the extent that you transfer that off balance sheet. And what you need to do is see if you can reconfigure that debt to another asset or just assign just the equity and not the debt, for example. So now I'm going to show you the value of having put together a balance sheet like this. Additionally, if you were setting up a trust to interact with the balance sheet, I highly recommend usually that clients look and treat the balance sheet something like a checking and savings account. So if the client's balance sheet, let's use this as an example, this has a client which consider or act like their balance sheet was their checking account, and the trust they set up, which I would recommend it be an intentionally defective grantor trust because of the powers that allow you to swap assets for fair market value without creating a sale. One of the things, the benefits of putting together a balance sheet like I showed you on the prior page is that we're able to transfer assets or swap assets back and forth and decide which assets are best to transfer and keep on balance sheet. And that changes over time because the assets you may have transferred over here, you may want to now have back on balance sheet because these are low basis assets per se, and now you sold something over here that has a high basis, and it'd be good to swap those out. So you get the step up basis over here. The high basis assets over here wouldn't pay any capital gains, right, except for the future appreciation. So in this example right now, I'm going to pretend that we have $2.5 million of assets and fair market value that we want to transfer. On the client's balance sheet right now, we have a $2 million worth of 3M stock, and we have $500,000 of cash value life insurance policy. We're going to exchange that with the intentionally defective grantor trust. Now, usually there's something called the transfer for value rules that makes a death benefit taxable if you do effectively a sale. The intentionally defective grantor trust is an exception to that rule. So we can transfer that, sell it without essentially making the death benefit taxable. But I could swap these two assets here, bring them over here for fair market value, and take $2.5 million of additional assets from over here back on the balance sheet that have a lower cost basis than the assets I transferred over here. These both have this one has the exact same cost basis as the fair market value, $2 million of fair market value, $2 million of cost basis. This asset here is a life insurance policy. We don't care about the cost basis, it's going to pay out the death benefit unless we're going to surrender it. So now over here, I've transferred $2.5 million with $1,200,000 of cost basis. So we got $1,300,000 in a step up in basis, which if you assume a 30% tax rate, that's equivalent to something like $400,000 in capital gains that we just saved by doing that transaction, having already had an intentionally defective grantor trust funded and swapping assets back and forth. And this is just an example of the importance of cost basis planning. So CBS helps with cases like this in both the technical questions, things like I just mentioned about the transfer for value rules with the life insurance policy and so forth, or any modeling of a transaction or helping you decide which assets are best to transfer, etc. If you have cases that you'd like to work with us on, our number is here at 763-450-1870, or look us up at cbsbrokerage.net. My email address is jeremy@cbsbrokerage.net. Thank you so much for watching.